Welcome back, everybody. I just want to be really clear when we're talking so much about the U.S. Federal Reserve. And for my Canadian viewers, of course, this is global in terms of how we access information today. But for my Canadian viewers, we're doing this because what the U.S. Federal Reserve does impacts all of us in terms of how they affect the markets, the risk assets, and of course also the BOC, which, by the way, is still expected to raise rates by 50 basis points on October the 26th. That affects what you pay on your credit card, your home, your auto, and of course what the bank pays you for your deposits, etc. So back to my previous question in the other segment, Danielle, which is, do you think that there's a financial crisis looming?
So I mistakenly said I look forward to it. I do not look forward to a financial crisis breaking out. But we have to understand that headed into the pandemic, there were already signs. There were already signs of breaking in the credit markets. And what we did to resolve the moment of the pandemic was to actually bring interest rates so low that we invited much more credit and debt building into the system. And now you see headlines. The International Monetary Fund, they've had to bail out Sri Lanka and Ghana. There are many other countries that are suffering because the US dollar is so strong and they've loaded up on so much debt. And the reason I worry about a financial crisis is we have similar situations in the non-financial, in what we call the corporate debt market. And there are many, many companies that have overloaded on debt. And whether you're talking about Moody's or Standard & Poor's or Fitch, you've had credit rating agencies come out these last few days and seriously increase the default rate assumptions. They're saying, wait, a lot more companies are going to be going out of business because they've taken on debt loads that are simply untenable unless you keep interest rates at the zero bound. And we're certainly not there. And it appears that the Fed's not finished yet. That again brings us back to what we were originally talking about. At some point, something could break.
Yeah, something could break, and it's everybody's guess, really, even though
Mm-hmm.
everybody in the business doesn't want to say they're guessing. But we've got to predict. And given the set of circumstances, you have to decide in your own mindset whether or not you think that the US Federal Reserve will actually recognize, as the market's telling them, you're going to break something. You got $50 trillion of debt extra, interest rates on in interest payments with a higher interest rate. I mean, let alone corporate debt at a higher rate, rolling over. What industries are at risk there in terms of needing to renew their debt and at a higher
Mm-hmm.
rate, let alone people with variable mortgages. I mean, if we were a betting set of professionals here, what do you think the Fed does? We kind of talked about this, going to keep raise, but then maybe hold.
I think that the Fed is hoping that they're able to bring rates up to a much higher level than what we're used to. Maybe even have the flexibility to not have to go back down to the zero bound. Maybe they take the Fed funds rate to a new floor of 2% going forward. But again, I would raise the issue of quantitative tightening, of reducing the size of the Fed's balance sheet, alongside, by the way, other central banks doing the same thing. The liquidity being pulled out of the system is quite extraordinary, suggesting that the Fed will have to potentially hit the brakes in 2023 if we get that far, because there are so many areas of fragility. I saw that between non-financials and sovereign debt, there's $1 trillion of refinancing on the docket here in the next year or so. And you raise the very salient point that's less familiar to us in the United States, that so many other countries with very overvalued balance sheets do use
Mm.
variable adjustable rate mortgages. And the prospect, I've been writing about this, that we see a balance sheet recession in the Nordics, in New Zealand, in Australia, and boy, especially in Canada. They're very real prospects, and balance sheet recessions take much longer to play out. They leave a lot more scarring in the economy. And we have to bring China into the picture ever so briefly, because those foreign buyers are simply not there as a backstop the way that they were in the aftermath of the last financial crisis.
And just to pick it up real quick on the Canadian front, what do you see occurring here?
Well, as fast as home prices appear to be declining, as fast as bubbles in particular areas appear to be coming off of their highs, it's happening faster north of the border in Canada. And it should be, because there was a greater degree of overvaluation in the Canadian housing market. And again, there was more of a reliance on foreign buyers in Canada than what we had in the United States in certain markets, Miami, Los Angeles.
It seems as though the buyers, the foreign buyers, apparently the money is still coming in here because they want to exit other countries. We'll see if that can continue. Danielle, great to be with you today. Thank you so much for all of your insight and wisdom. I appreciate it.
Thank you for having me.
Thank you. And thanks everybody for watching. Stay tuned for more on The Buck Stops Here.